Welcome back. Markets are starting the day off in positive territory, and markets, of course, have rallied since the early portion of June in the U.S. and the mid portion of July here in Canada. Our next guest is going to talk to us about selling positions when that may become necessary in your portfolio. He is Jason Del Vicario, Portfolio Manager of Hillside Wealth Management. Jason, great to have you with us again. Before we get to your thoughts, and they're interesting thoughts on selling or trimming, talk to us about these market rallies we've seen in the United States. Are these rallies for real? Are they bear market rallies that investors should be leery of?
Well, my best guess would be that this is a relatively strong bear market rally until, of course, proven otherwise. If we look at previous bear markets, these relatively strong sort of 10, even upwards of 20% rallies are quite common. In fact, we see generally the most sort of positive days during bear markets. So it's not uncommon to see 2-3% plus days during bear markets. So I don't know. But my best guess is that this is a bear market rally. Okay,
you brought some thoughts with us, to share with our viewers on selling positions, either exiting completely or trimming positions. Why don't you begin that conversation for us?
Sure. So buying is relatively easy. I mean, we do an exhaustive due diligence process, but buying a position, investing in a business is relatively easy. Selling that position or replacing that position, which of course also implies selling, is very, very tricky. And the reason for that is because businesses or stocks, in theory, have infinite upside potential. So when is it that an investor is faced with a decision to move on from a company? And we have a few thoughts on this, as you indicated. The first for us, anyways, is that we will sell or most likely trim a position when the weighting of that position becomes greater than double the initial target weight that we have. So what that means is if we have an initial target weight of 5% for a position and it grows to 10% in the portfolio, once it gets beyond 10%, we will trim to keep it at that 10% weight. The other situation where we would see us trimming a position is when the value of the business is greater than double the fair value estimate that we assign to the business. So if we like a business and we think a fair value estimate is, let's say, $1 billion, and that position now trades at greater than $2 billion, that would also be a sign for us to trim the position. So those two situations, we would look to trim the position, not sell outright. Where we might look to sell the position outright would be in the following two scenarios. Number one, the financials of the company have deteriorated to the point where we do think that this is a long-term impact on the intrinsic value of the business as opposed to a short-term impact. That would see us move on from a position. And the second scenario would be where we found a business that we feel offers better forward return prospects for our investors. Again, that would see us sell a position outright. So I think it's important to discuss, not only our discipline, but for investors as well to employ a selling discipline, much like they might employ a buying discipline.
A big mistake that many retail investors make is falling in love with their winners, correct? And this notion of discipline is intended to counteract that idea to hang on to your winners.
Yeah, that's exactly right. There's an expression, we want to let our flowers grow and trim our weeds. I should provide the caveat that all of this sort of discussion sounds like we want to be very active, and that's quite the contrary. We do not want to be active. If you select your positions well, with a good fundamental basis in terms of why you've invested in that business, ideally you want to be able to hold those shares for 5 years, 10 years, 20 years. For example, if you look at Constellation Software went public in 2006 at $20, trades at some $2,000 today. I think one of the mistakes many investors have made along the way with Constellation Software is selling too early. And you can insert many other names such as Microsoft or Disney or these really wonderful high quality, predictable businesses, you want to own them for the long term, certainly.
Okay, and you've been using this discipline, in fact, to trim some positions of stocks that you have held for clients, and I think that you've spoken to us previously about in your appearances with us. One of them is HEICO Corporation, an aerospace player.
Right. So HEICO is a wonderful company. It checks almost all of the boxes that we look for at Hillside in terms of a business that we want to own for our clients, but for the fact that they trade at 52 times earnings. Our fair value estimate of HEICO is around 20 times earnings. So it is now greater than double our estimate of fair value. And so that is a position that we've looked to trim. And it ties very nicely back to what we were talking about at the beginning, Paul, in that we are being afforded this ability to trim and sort of reposition our portfolios a little bit during this rally, whether it's a bear market rally or we're going to go on and set new highs. I don't know. But the recent movement over the last 6 weeks has afforded us this ability to enact some of our selling discipline.
And Checkpoint Software, you're also trimming the position there.
Right. And so Checkpoint has become, we've actually reduced our conviction level of Checkpoint from a 5% weight to a 3% weight. And it is now greater than 6% in our portfolio. So 6% obviously greater than double 3%. And so we're trimming that down a little bit in conjunction with one of the rules that we discussed at the outset.